What's up, you guys? pltr here, and today we're going to be talking about 10 stocks that I would be buying in April of 2021 as a long-term investor. It was kind of hard for me to find 10 companies that I felt were appropriately valued or even undervalued in the current market conditions. Now, I'm not going to have the time to do a full company breakdown on every single one of these companies. A lot of them I have already done company breakdowns on, but if you want me to do an entire video dedicated to one of these companies, make sure you comment down below, let me know which one, and I would love to do that for you guys. So hit the like button, subscribe to this channel, and let's get started. Now, on this list, there are going to be some companies that I think are extremely undervalued, some companies that I think are appropriately valued, and other companies that I just think overall are at a decent valuation, and even some of them are going to be pretty speculative. First company that we're going to be talking about is Nissan Motors, and the ticker is NSANY. Right now they are trading for about $11.20 per share, and Morningstar has them with a fair value of $28. So obviously they are trading way below their fair value. And one thing you do have to realize is that fair value doesn't mean that a stock is essentially undervalued. It just means that Morningstar's analysts believe that that is what the fair value of the stock is, meeting their criteria. And obviously Nissan is far below it. Now, Nissan, everybody knows what they do. They're a car manufacturer, and they sell about 4 million vehicles each and every year throughout the country and the world. As well, they also originate and facilitate loans for their vehicles, which is another great aspect and a great way for them to make money. Right now, they are trading a bit high on their 52-week range, but if we zoom out, which we're going to do when we look at the chart, they're still at a pretty attractive valuation. Right now, they have a $22 billion market cap, and I believe currently that the automotive industry is at a great point and an undervalued sector in general. So if we look at the 3-year chart for Nissan as of right now, the stock was trading at $21.26 3 years ago from today. The stock hit lows of $5.75 during the height of the Rona, which obviously makes sense. And since then, we have recovered very strongly back to $12. But overall, we are still nowhere near where we were a couple of years ago. Now, I'm not saying that the stock is definitely going to go back up to $21 because the stock has been downtrending for a long time now, but I think that this is definitely a company to keep an eye on and to watch going into the next couple of months. And for me, it's a stock that I would at least keep on my radar going forward. Now, another company that I would be watching is Mace. I did an entire breakdown on this company, exactly what they do, the properties they own. If you want to see that video, you can find it on the channel. As of right now, Mace is trading far below its fair value price. Right now, we closed at $11.80, and Morningstar has its fair value set around $29. Now, this is a stock that was hit massively by the Wall Street Bets, short squeeze a couple of weeks ago, and I originally had a position in this stock, but I ended up selling not too long ago because going from $9 a share up to $25 a share in just a couple of weeks makes sense for me not to be in that position anymore. Mac, for those of you who do not know, essentially they're kind of like a Simon Property Groups where they own plenty of different shopping and retail properties. Unlike Simon, really Mac owns a lot of high scale properties and high scale shopping centers that are outdoors, and really more of these big town centers that you're seeing popping up within your area. As of right now, Mac has a dividend of 5%, which is pretty huge when you really think about it. A sector that has been hit so hard within the past year, to still offer a 5% dividend and to be this undervalued, I really, really like this company. And I think that this is something that many people should keep on their radar. Now, if we go and we take a look at the chart, for me, I think that Mac anywhere under $11 is a buy. More specifically, $10 for me is a no-brainer, and that's really where I'm going to be targeting to enter this position. What I might actually do in the next couple of weeks is start to sell puts on Mac in hopes that, number one, I actually get filled, and in the meantime, I can grab premiums along the way. Now, another company that I would keep my radar on is going to be Bud, B-U-D, and this is Anheuser Busch. Hopefully everybody knows what Anheuser Busch does if you're over 21 years old, but they are one of the largest brewers in the world. They own 5 of the top 10 selling beers. Now, if we look at Anheuser Busch, they do have a nice forward dividend of 2.27%. Their fair value is $90 and they are trading right now around $63.95. If you're somebody who is looking to start a position in the beverage industry or maybe just add some more diversification to your portfolio, I think that Anheuser Busch is at a very attractive level right now, especially if you look at the 3-year chart. The stock was trading at $110 3 years ago and actually hit lows at the peak of the Rona of $32.50. Since then, we have slowly been recovering with a decent dividend, a fair value of $90. I think that this is a stock that would be great to have in your portfolio, especially if you don't have anything in the food and beverage industry and you want to add some diversification to some of the positions that you have in your portfolio as of now. Now, the next stock that we're going to talk about is Salesforce. The ticker is CRM. And from a technical standpoint, from a trading standpoint, if you're in my academy, you guys know that I've been watching this stock for a long time now. This thing from a technical standpoint has been squeezing for a very long time and looks like it's ready for a breakout. But from an investment standpoint, CRM is pretty fairly valued. Stock's fair value is $265 and we last closed today at $210. Now, Morningstar says that the 5-star price for this company is $185, which is not too close from where we are right now. With an extremely wide economic moat, I think that this could be a great company to add to your portfolio if you're somebody who's looking to add a large growth tech company to your portfolio and you don't see any that are at a fair value as of right now. They have a massive $200 billion market cap, no dividend, and they have a consensus forward PE of 61, which is a little high, but for a tech company and a large growth tech company, it's really not that crazy. If we take a look at the charts, however, you can see that this stock has been doing really well over the past 3 years. We were trading at $113 just a couple of years ago, and we hit highs of $284. But for your traders out there, one thing that you'll notice is we have a massive bull flag forming here with a huge retracement down to massive, massive, massive support at $200. For me, I really like this company as not only an investment, but potentially a 3 to 6 month hold as a trade. We're offering just back up to the top of this flag a 12% return. And if we can break out from there up to $284, we're offering a 35% return, potentially within the next 6 months, which is huge. So not only do I like this as a trade, I like this as a potential investment. Now, taking a look at the next company, we have Hanes Brands, HBI. Everybody knows what Hanes Brands is. Obviously, they make underwear, they make socks, they make undershirts. This company has been around for a very, very long time. And of all the companies that we're talking about today, to me, this is definitely the safest bet out there. Fair value for this company is $24. Their last close was at $20, and they do have a very narrow economic moat. For those of you who do not know what economic moat is, I will do a video in the future, but it's essentially ways that a company can make money as well as how are their competitors. A company who has a wide economic moat has tons of ways for the company to make money and generate revenue. And also they don't have a ton of competitors who can come in and just sweep up that market space that they have. So the one downfall for Hanes is that they do have a low economic moat because all they really sell is undergarments and kind of sleepwear. And they also have a narrow economic moat because it's not that hard for somebody to come in and take, retail space from them. Even though this is a company that's been around for a very, very long time and has a very strong brand behind it, it wouldn't be that hard for another company to come in and take their place. Now, they do have a forward dividend of 3%, a consensus PE ratio of 12, which is extremely attractive. And overall, I do think that this is a pretty solid company that you could add to your portfolio. Not one of those companies that's going to give you a couple 100% returns in the next 4 or 5 years, but overall a company that will probably give you about 10 to 12% returns per year on top of that attractive dividend. For me, this company has always been, kind of a recession-proof play. We did see this take a massive hit during the Rona last year, but the entire stock market did. And you can see it quickly recovered like a lot of other companies. Because if we were to go into an economic recession, people are still going to need socks. They're still going to need underwear, hopefully. They're still going to need t-shirts and work clothes. And a brand like Hanes is not a luxury brand where people are going to be unable to afford it. So overall, I really like Hanes. The next one that we're going to talk about is XOM, or ExxonMobil. Overall, I will say I think that the petroleum and energy sector is still undervalued. If you guys watch a lot of my other company breakdowns, I did a breakdown on Abraxas Petroleum, which I thought was extremely undervalued as well. And it's the same for Exxon. Now, I'm not somebody who invests in trade in natural gas and oil, but overall, if I'm going to, I would usually want to invest in a company as opposed to an ETF. And for, as far as Exxon's considered, they're about fair value right now. Morningstar has fair value at $74. Their last close was at $56, and they have a 6% forward dividend, which is extremely high for a company like this. Now, if we do look at the chart over the past 3 years for XOM, you will see that you really would not have made a good gain. I mean, you actually would have lost a considerable amount of money. Exxon was trading at $87 in the past, trading was this October of 2018. And then we fell all the way down to lows at $30 before finally bouncing at the bottom. And we're trading right around $55 to $54. Now, for me, I'd be looking to enter a position long at $52. And this, once again, is sort of like Hanes brand, that you're not going to make these massive tech gains as far as percentage are considered every year, but it could be a good way to diversify your portfolio. And as far as trading is considered, I do think, like I said, the energy sector is undervalued, and I do think that Exxon will probably be back up at $66 within the next 3 to 5 months. Overall, this is not something that I would buy, but I felt that I should put it out there because it's something that you could add to your portfolio as a bit of diversification, or if you're just looking for a fair value energy company that you can just add to your portfolio. Now, the last 4 companies that we're going to talk about are going to be more speculative investments, more based around technology, and they're going to be companies that are not at a deep discount or even under fair value. These are not companies I think that are undervalued. These 4 companies I think are fairly valued, but I still wanted to add them because a lot of times with these great tech companies, you're not going to end up getting it at a deep discount unless it's, a recession or a crash, or, kind of like what we saw happen last year. The first one is going to be Skyworks Solutions. This is a company that I love. They're a semiconductor company, and we have 2 of them in these fair valued stocks that we're going to talk about. And really, they make a lot of chips for iPhone and a lot of different companies. I've talked about them plenty of times. I can actually do a full breakdown on them if you guys want in the coming weeks. This is a company that I really like. They have amazing, strong financials and fundamentals, which we can talk about in a deep dive video in the future. But as of right now, the stock has been performing extremely well over the past 3 years, trading at lows actually of $60, just about 2.5 years ago, all the way up to highs of $195. So if you were to have purchased this 3 years ago today, you would have made 92% in the past 3 years. That would have been a solid investment. Now, looking at the last 3, the next one we have is AMD, or Advanced Micro Devices. This is a company that is not anywhere near undervalued, but this is a company that I've been a fan of for the past 4 or 5 years, and I was actually buying the stock at one point at like $6. Right now, they're trading at $76. They have a fair value of $77. They have a 5-star price of $46, but I don't think we're ever going to get that low again. Now, they do not have a dividend, as most tech companies don't anymore, and they do have a pretty high consensus forward PE of $39. Overall, AMD has great fundamentals. The company has one of the best CEOs in the world, and in my opinion, for sure, one of the best woman CEOs of any company that there is out there. If you do look at this 3-year chart of AMD, the stock has not retraced even in the slightest in the past couple of years. But right now, I think that you're getting a great company at a fair value. And for me, if I was looking to add a large cap growth tech company at a very good value that I think will do amazing things in the next 10 years, AMD would be one of them. All right, now the next one is going to be NIO. And for me, this is definitely going to be one that some people might totally agree with, and other people might think I'm absolutely insane for putting NIO on this list. One thing I will say is I was buying NEO heavy at $1.90, $2, $2.10 this time last year, and I did believe in the company, but more so it was just in hopes that the stock would rebound. After doing a lot of research on the company within the past year, watching how the stock has been performing, I've actually really liked this company. I've really fallen in love with them. And at this point, you are not getting a good deal. Like, I'll straight up say that. If you're looking to buy and hold for the next couple of months, for me, this is not the type of stock to do that. However, I would say that if you're looking to hold this company for the next 5 years, this is a great price to get in at. Overall, though, I think that within the next 10 years, this would be a massive investment for some people. I've done multiple deep dive videos on this company, so if you want to look more into the company and get my opinion of them long term, go and check out those videos. And now the last company that we're going to be talking about today is going to be Microsoft. And like the last couple ones we spoke about, Microsoft is nowhere near undervalued in my opinion. You know, Morningstar has the fair value of 263, and for me, in order to be buying this at a deep discount, I would need it at about $170, $180. But for me, you don't always have to buy a company that's extremely undervalued to make money. If you look at the forward dividend, it's about a 1% dividend, but for me, that's not why I'd be buying the stock. The forward PE is about 28 as of right now. Their capital allocation is excellent. They have a very wide economic moat, and to me, this is one of the most solid investments that you can make within the next 5 to 10 years. Once again, not one of those companies that you're going to make thousands of % return on. This is a company that's going to do well, whether the economy is doing great, whether the economy is doing bad, lockdowns or no lockdowns. Overall, this company is one of my favorite investments, and I would be buying it at this price. Guys, thank you so much for everything. It really means the world to me. Thank you for all of your support. If you want to be part of my private stock market academy, get access to every single trade I take live as soon as I take them, live stream with me and my team every single morning for the first hour of market open, get access to our 60-hour course library and our private Discord. Use the link down below. Use the code Academy90 to get started for $10 your first month. As well, make sure you go check out Twitter. It is the only social media platform that I'm using as of right now. You can stay up to date with all of my trades, all of the news that we put out, as well as top flows of the day. It's a great community to be a part of, and it's 100% free. Thank you guys for all the support. Hit the like button, subscribe to this channel. I'll see you guys next time. Peace.